Look, something incredibly strange is happening in America right now. I want you to picture two people. They have the exact same salary, the exact same job, and they sit in the exact same tax bracket. Yet, one of them just got handed an extra $4,300 this year, while the other, they got almost nothing. They live in the exact same country, under the exact same law, but they are experiencing a completely different financial reality. So, welcome to this explainer. Today, we're going to map out exactly what is happening to your money and how you can navigate the new rules of the game.
Okay, let's dive into this, because the number $2,300 is literally the one everyone is talking about right now. The Tax Foundation ran the numbers and reported that the average U.S. taxpayer is going to see a nearly $2,300 tax cut in 2026. That is the massive headline echoing everywhere. But, if you understand anything about how these financial systems actually work, you know that this number hides a much, much messier truth.
Because averages, they completely hide reality. Think about it like this. If 10 people are in a room and one of them gets a $23,000 tax cut while the other 9 get absolutely zero, well, the average is still $2,300. This new system doesn't just hand everyone a uniform equal check. Instead, it completely reshapes the rules of the board. The people who understand these new rules, they win big, taking home thousands. And the people who don't, they just keep playing by the old rules and wonder why absolutely nothing changed for them. The engine behind all of this is the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. It is the largest federal tax shift we've seen since 2017. And here is the really crucial thing. Its rules are already sitting inside your 2026 tax return, whether you realize it or not. So we need to unpack this neutrally, step by step, to show you the exact mechanics of this shift.
The $40,000 SALT shift.
And this brilliantly illustrates the single biggest change in this entire bill for folks living in high-tax states, places like New York, New Jersey, California, Connecticut, or Massachusetts. For years, the SALT deduction, that's state and local taxes, was firmly capped at $10,000. That cap meant no matter how much you paid in property and state income taxes, you could only deduct $10,000 on your federal return. You were effectively being taxed on money you'd already paid in taxes. But look at the difference now. This new bill lifts that cap all the way up to $40,000. That is a massive structural shift in the tax code.
Let's look at the real-world math for a married couple in New Jersey, just to put this in perspective. Say they pay $15,000 in property tax and $13,000 in state income tax. Their total SALT is $28,000. Under the old law, they could only deduct $10,000, but under the new law, they get to deduct the full $28,000. If they're sitting in a 24% federal tax bracket, that translates to a real $4,320 right back in their pocket. That's not some far-off projection, that's real money today.
So the crucial point is, the fundamental question isn't just, did the SALT cap go up? The real question you have to ask is, does your total itemizable stuff, your state taxes, your mortgage interest, your charitable giving, add up to more than $31,500? Roughly 90% of filers typically just take the standard deduction, which for a married couple in 2025 sits right at that $31,500 mark. If your deductions exceed that, you itemize and you win. If they don't, this massive change literally does nothing for you. But there's a catch, and it's aimed right at high earners. If your modified adjusted gross income is over $50,500, the SALT benefit actually starts phasing out. You face a penalty where it's reduced by 30 cents for every dollar you earn above that threshold. The brutal reality of this wealth logic is that the people who pay the absolute most in state taxes don't actually get the full benefit. The true winners here are squarely in the middle of the middle class in those high-tax states. The Trump account. Now, let's shift gears to a provision that is entirely new, something that didn't even exist before July 2025. It is aimed squarely at families, and it starts with this number, $1,000. The federal government is essentially providing literal free seed money here. For every eligible child, the government contributes an initial $1,000. Let's break down the specific rules of how this works. Families can contribute an additional match of up to $5,000 per year, and employers can even pitch in up to $2,500 per year completely tax-free. And this isn't just sitting in cash. The funds are invested directly into S&P 500 index funds. The rule is the child cannot touch this money until they turn 18. Once they do, it's treated just like a traditional IRA. And get this, even if a family adds absolutely nothing to that account, a conservative 7% market return turns that initial $1,000 seed into roughly $3,400 over 18 years.
Now, what's really interesting about this slide is the sheer scale of adoption we're seeing. 4 million children have already been enrolled in these accounts. 4 million. But the stark reality of this highly targeted policy is simple. If you have kids under 18, this is an absolute no-brainer. But if you don't have kids, you get absolutely nothing from this provision. It tells you exactly where the bill's priorities lie.
The hidden losses. So we've talked about what the new rules give. Now we have to look at what the bill quietly took away from the system, because this is the part you definitely aren't seeing on the evening news. If you were planning on making green home improvements, the math just changed on you overnight. The 30% clean energy tax credits for things like solar panels, battery storage, and geothermal systems suddenly expired on December 31st, 2025. Poof, gone. If you were waiting for that federal credit to help pay for an installation, you unfortunately missed the window. Just look at what was preserved or enhanced: income tax cuts, property tax deductions, and investment accounts for children. On the flip side, look at what was cut: green energy incentives and sustainable home upgrades. The bill's priorities are crystal clear. It's designed to keep money flowing into existing financial systems, namely your property and the stock market, rather than incentivizing energy independence. 4 wealth logic scenarios. So how do you actually apply all this information? You need to map yourself to one of these 4 scenarios to understand your next move. First, if you live in a high-tax state, do the math. Do not just assume. Calculate your deductions to see if you can itemize and beat that $31,500 threshold. Second, if you're a parent of a child under 18, open the account. It is literally the closest thing to free money the code allows right now. Third, if you want green upgrades, you have to recalculate your payback period without that 30% credit. The math just has to make sense on its own now. And fourth, if you're a high earner, you must plan for those phase-outs. Passively accepting the default rules in any of these scenarios means you are simply leaving money on the table. The real macro price. Let's move to and see how this builds, because before we wrap up, we really have to zoom out to the broader economic reality. This bill makes the individual tax cuts permanent, sure, but the actual price of permanence is the national debt, $36 trillion. The government isn't cutting trillions in spending to pay for these tax cuts. This money is being absorbed directly into the national debt. And the unbending rule of macroeconomics is that borrowed money eventually becomes someone's tax bill. These cuts lower your burden today, absolutely, but they completely reshape the future trajectory. At some point, this mounting debt will demand a response, whether that's higher rates later, reduced government services, or entirely new taxes altogether. You really have to understand both the immediate win and the long-term cost. The wealth logic here is simple. The game has changed, and the people who understand the new rules will position themselves to thrive, while those who ignore them will just fall behind. So I'll leave you with this. Which rules are you playing by? Are you adapting to 2026, or are you stuck in the past? If this explainer helped you grasp these vital changes, please share it with someone who needs to hear it. And make sure to subscribe to US Money Impact so you never miss out on understanding the rules of your money. I'll see you next time.